So what's different this time is that, 1980 was the end of the secular bull market. Silver had been rising for a decade.
Yeah.
And there were plenty of fundamental drivers, but at the end, it all became about sentiment. It doubled multiple times in the last sort of few months. And if you look at the 76 to 1980 period, it went from $100 to $850. So that was 8.5 times. In 2011, it was not a fundamental run up. I think that yes, we're at all-time highs, and it's uncharted waters, so to speak. But how did we get here? I believe that a lot of it is fundamentally driven this time, and I think that that's what makes it different. I mean, it's always dangerous to say it's different this time, but frankly, in many ways, it is different this time. You actually made the point for me. I'm glad you asked that question because somebody asked me not long ago, how did you know silver was cheap at $20? And the answer was nobody wanted to talk to me, except you, David. You did want to talk to me. But
you had a great book. Everyone should check out the great Silver Bull.
But yeah, I mean, it's the whole thing. People don't want to buy what's hated, and they want to buy what's loved. Right now, you could argue silver is loved. Back then, silver was hated. So it was an easy buy. And, I've been saying recently that it's harder to be a contrarian now because, silver in particular, but so many other things have moved up so much that for me, at least, it's much more difficult. If I want to look for, an undervalued sector, it's starting to be slim pickings. But that doesn't mean that, the opportunities aren't there.
What did you mean by undervalued sector? $20 silver, why was it undervalued?
It was undervalued because I had done the homework, I'd done the research. I could see that we were facing deficits. We had started already into our second year of structural deficit in silver. We were consuming about 15 to 20% more every year than we had of supply. Just quickly, the silver market is 1 billion ounces a year. About 85% of that comes from mining, and about 15% comes from recycling. Well, silver mining supply peaked in 2016. That's 10 years ago. At the time, it was 900 million ounces. Today, over the last 5 years, we haven't managed to get meaningfully above about 830 million ounces. So demand's gone up, supply has been flat. So we've been in a structural deficit situation. The Silver Institute has forecast that over the next 5 years, we're going to continue to be in silver deficits, and we will reach new record deficit levels. So, I could see this back then, was willing to be patient. I looked at that. I looked at different indicators. And for me, it was, like I say, I felt, maybe it's a little bit masochistic, but it felt relatively easy and comfortable to buy things that nobody else wanted to buy, and to be willing to sit and be patient. I like to say patience is the rarest commodity, and the last 4 or 5 years have proved that to be true.
The silver market produces roughly 1 billion ounces annually, with mining contributing about 85% and recycling the rest. Since mining peaked in 2016, production has struggled to surpass 830 million ounces per year, while global demand continues to grow 15-20% faster than supply. This persistent deficit, projected to deepen over the next 5 years, lays the foundation for long-term price appreciation. Structural deficits, unlike temporary shortages, create predictable upward pressure. Observing these trends early allows patient investors to position ahead of the crowd, benefiting from market imbalances before sentiment catches up.
That's a good way to think about it, because I think in the very near term, probably yes. I do think that if you look I'm not a technician, but if you look at the chart from a technical perspective, this is one of these parabolic runs higher, and typically, historically, you do get corrections, and you can get pretty significant corrections. Silver's known to be volatile, and that's why, thankfully, a lot of people stay away from it, and that creates opportunity for those who aren't afraid of it. But I think that suggests that in the near term we could be due for a correction. I've run the numbers. I've looked at this historically. If you look, for example, at the last big run, which was from 2001 to 2011, silver started out at $4, and ran to 49 and change in April of 2011. So that's more than a 10x. And during that decade, you had 5 corrections of 15% or higher. The average was 30%. And yet, despite multiple 30% corrections, you still went up more than 10x. So that's why I think that it's all perspective. You have to know where you are in the larger, the bigger picture, in the larger bull. And so I think it's still quite early, but that doesn't mean we're not due for a correction to rebalance sentiment. So what's different this time is that 1980 was the end of the secular bull market. Silver had been rising for a decade.
Yeah.
And there were plenty of fundamental drivers, but at the end, it all became about sentiment. It doubled multiple times in the last sort of few months. And if you look at the 76 to 1980 period, it went from $100 to $850. So that was 8.5 times. In 2011, it was not a fundamental run up. I think that yes, we're at all-time highs, and it's uncharted waters, so to speak. But how did we get here? I believe that a lot of it is fundamentally driven this time, and I think that that's what makes it different. I mean, it's always dangerous to say it's different this time, but frankly, in many ways, it is different this time.
Silver's history offers lessons on volatility and patience. From 2001 to 2011, prices rose tenfold, despite recurring corrections averaging 30%. Understanding the larger trend is crucial. Short-term pullbacks are normal, even in explosive bull markets. Earlier secular bull markets, like 1970s silver, were driven by both fundamentals and sentiment, culminating in dramatic price surges. Today, fundamentals, supply deficits, geopolitical considerations, and recognition of silver as a critical mineral play a central role. Recognizing when a market is fundamentally strong yet temporarily underpriced is key to navigating both gains and inevitable corrections.
And I think that's what's kind of given people, the relatively early investors, the conviction to get in and to sit with it until it's run to 50, 60. David, think about it like this. I am prepared to say that we're due for a correction. And part of it is because it took 45 years to match that $50 level. So I had been saying that once the next time it gets to 50, it's going to ultimately see that as a new floor. And it took 45 years to reach 50, surpass it, and stay above it. And then it took 3 months to go from 50 to 100.
Yeah.
And so that's why, from 45 years to 3 months to go to a double from 50, that's pretty aggressive.
Yeah.
And but as I say, everything that's led to where we are now has been more than anything fundamentally driven with these supply deficits, this silver being deemed a critical mineral by the U.S., China controlling 60 to 70% of silver refining. The U.S. looking at spending $2.5 billion on a critical minerals, a strategic minerals stockpile. Trump telling his trade advisors, we should consider the idea of price floors on these critical minerals. There's a lot of India now saying that you can use silver as bank collateral. I mean, it's on and on and on. And now you've got people like Bank of America. I think it's Michael Widmer who said that he thinks that, based on the ratio and so on, we could see anywhere. I mean, I'm not that aggressive, but he's saying we could see anywhere from, I believe it's $135 to $309 this year. I think that's unlikely.
Yeah.
But I do think we could reach the lower end of his range.
Unlike past speculative surges, current silver momentum is deeply rooted in tangible factors. Strategic stockpiling by governments, dominance of Chinese refining, and U.S. initiatives on critical minerals reinforce demand. Financial institutions and industrial users act as consistent buyers, supporting prices through measured accumulation. Even short-term corrections have been muted, signaling strong underlying intent among investors. This unique combination of structural deficits and broad, persistent demand sets today's market apart, making silver more resilient to typical cyclical swings and positioning it for potential new price floors unseen in previous decades.
Again, I'm not a technician, but
Yeah.
I know of that enough that these ceilings that take so long to break through typically do become new floors. And I think that, having gone to such high levels right now suggests that it's very realistic. I was expecting a correction through all of last year, frankly, a more meaningful correction, and it never came. I mean, from May until January, all you had was a dollar, a couple of dollars. When it finally broke in mid-October, broke $50, ran to 54, went back to 48, stayed around that range for about 3 weeks, and then just ran higher. And so for silver in particular, but for gold as well, what that said to me, from the perspective of watching how these markets behave, price means a lot if you look at how it behaves. And so to me, it said that there is a lot of money, intent buying on the sidelines that was just sitting, waiting for the smallest pullback to just buy. I'm convinced there were traders that had instructions that were, you see this thing pull back $1, $2, buy, accumulate. And that would explain the kind of behavior that we had all of through last year right up until now. Absolutely. And we were there for a long time. And I believe that's why we had silver going sideways for so long. Right now, I would say that price is probably somewhere around $30 all in, and maybe even a little bit higher. So, if you're looking for an absolute floor, I would think that would probably be an absolute floor. Obviously, that's a long way from where we are now. Doesn't concern me because I do think that 50 would be the new floor. Yeah. And frankly, I would even be kind of surprised if we saw it go back to 50.
Analyzing price behavior reveals hidden investor psychology. For example, sideways movement in 2024 wasn't stagnation. It reflected strategic accumulation from sidelines. Significant silver stockpiles in exchanges like COMEX and Shanghai allowed industrial users to meet demand without pressuring miners, delaying price spikes. As inventories draw down, the market eventually adjusts, often sharply. Recognizing these dynamics between supply, inventory, and investor intent is critical. It explains why silver can maintain strong fundamentals while appearing dormant, and why sudden accelerations often follow periods of subtle accumulation, signaling the approach of a larger bullish phase or even a mania-driven peak.
Well, look, the miners have had a tough time, and I believe what explains the fact that the silver price seemed capped, and this is how I had been explaining it for the last few years, from about, I would say, from early 2024, I was asking myself, others were asking me, look, if we're in a silver supply deficit, how come the price of silver isn't running up, is not compensating for that? And so I started looking around what would explain that. And the conclusion I had was that there were silver stockpiles, basically secondary inventories that were sitting on the COMEX, at LBMA, and at Shanghai. So several billion ounces. And the industrial, especially the industrial consumers, were able to go to these markets, buy a futures contract, wait for maturity, take delivery. And because you had this sizable amount of silver that was already mined, that was sitting above ground, any big consumer could go and buy this silver. But if you're buying the silver where it's already been produced, that puts zero pressure on the miners to bring new production to market. Yeah. So I had been saying these, you could see it by looking at the inventories. These inventories peaked in early 2021. Within about a year and a half, they had drained by about 40-50%. And I said in early 2024, we've got about 12 to 18 months left of this. And then these inventories get way too tight. And then it's all bets are off. And essentially, that's how it's played out. The market came to terms with the fact, and there's actually a report by TD Securities that came out probably about 2 weeks after I said that at a conference that said essentially the same thing, We can't support these. These inventories are being drawn down much too quickly, and again, 12 to 18 months before they're drawn down to levels that are much too tight, and then we're going to have to see a price response, and that's what took place.
Silver's journey is defined by cycles of undervaluation and extreme enthusiasm. Historical indicators such as gold to silver ratios, Dow to silver ratios, and housing comparisons help anticipate market extremes. While future price targets are speculative, understanding supply deficits, critical mineral status, and strategic demand supports a bullish framework. Investors can prepare for volatility while appreciating that secular bull markets often conclude with intense price runs. Patience, research, and contrarian thinking remain the greatest advantages. Today's silver market, unlike past bubbles, combines fundamental strength with structural scarcity, offering informed investors a rare opportunity to navigate both short-term fluctuations and long-term growth.
What takes us there ultimately, I believe, is a mania phase. I'm not trying to call for numbers like that to be sensational. When I wrote the book, I took the time to make a forecast. And I looked at what happened in 1980, and I thought, not unreasonable. I'm not talking about price right now, but not unreasonable to see similar kind of behavior, right? And so when you get to the end of a bull market, things go crazy, and people will pay anything for an asset. And it's the end of the bull market, but it's the mania phase of the bull market, right? So you get these huge run-ups in a very compressed amount of time near the end. And that's what we've seen several times in silver, but in other markets as well. You can talk about housing, you can talk about the internet bull at the end of the 2000s. It's not unlikely to happen again. And so, frankly, what I did was I looked at what got silver to that peak, and what are the indicators? What are the ratios and other things? How did it compare to other assets at that time? So the gold-silver ratio bottomed at 15-1, meaning it took only 15 ounces of silver in 1980 to buy 1 ounce of gold. The Dow to silver ratio bottomed. The average home price to silver ratio bottomed. So what all of that meant was silver had become way overpriced because it took, on average and historically, much fewer silver ounces to buy these other assets.
Okay.
So one good example is the gold-silver ratio.
Yes.
So 15-1 in 1980. And so I said, all right, if I'm going to use that as some kind of an indicator of where silver could go, for gold, I'm going to have to make an assumption of where the gold price would go.
Yeah.
So here's what's interesting. At the time, and it's in the book, I said, ultimately, I think gold can go to $5,000. Where are we today, David?